Hey guys, my name is Jonathan Reich. I'm a CPA in the state of Louisiana. Today I'm really excited to talk about a very nerdy and could be considered boring topic by some folks, but I don't normally get to do these like one-on-one topics where I'm just trying to cover something because normally I'm like reviewing a software to help save a business time or like how to implement a software that can save on credit card processing fees or writing tax guides. So to be able to cover a technical accounting topic is something that I really enjoy. Just to have that like face-to-face conversation and just really kind of get down into the weeds on something. So I'm really excited for that. I might throw in a couple mentions for some different softwares here at the end, but primarily at this time, it's going to be a conversation revolving around I guess revenue recognition is the best way to do it. And there's a GAAP has a ton of different revenue recognition rules. So GAAP is generally accepted accounting principles. And basically, when do I get to recognize revenue? When is it a liability? When should it be on my profit and loss, or should it be sitting on my balance sheet? And we're going to kind of go over that. So first, when money hits your bank account, actually, let me backpedal a little bit. First, a lot of small business owners and bank officers and investors still mix this up. They think when money hits the bank account, hey, that's counted as revenue. We got paid, we must have done something that we were supposed to do. So count it as revenue, put it on the first line of the profit and loss and move on. That's just not the case. And these are professionals, business owners, bank officers who make loans based on this information, investors who make decisions. These are people who should know better. And so you shouldn't have to have a degree in accounting to understand the difference, but apparently you do. So I'm going to walk you through that. When money hits the bank account, it's not always revenue. Most of the time it is, but not always. And so let me give you a really, really good example. In construction accounting, for instance, if I tell someone that I'm going to build them a house and it's $1 million home, and they say, hey, no worries, you look like a trustworthy guy, I'm just going to hand you the check for $1 million. Go ahead and cash it. Consider my debt obligation paid. I do not get to count $1 million of revenue as received on my profit and loss for my construction company when that check clears. You may say, why? They paid you. Well, it's based on percentage of completion or cost to complete in typical accounting lingo. So if I think that it's going to be $500,000 for me to build that house, and I've got $100,000 sunk into it so far, then I can recognize 20% of the money that they've given me. So I can recognize $200,000 of that $1 million as revenue. But what about the other $800,000 that's still sitting in my bank account? That is a liability. That is not your money. That is the hardest thing for folks to wrap their head around because you have not had substantial completion on your project yet. That is a liability. At any point, if you were to fail to complete that building, you owe that customer their money back because you did not handle your obligation. And so it's not revenue. And that's just construction. It gets even more nuanced. So let's talk about it. So bottom line up front, it's not when cash lands. There is pretty much a 5-step process that GAAP is going to outline. It's ASC 606. A lot of accountants are super familiar with it, but it only works if you consider what your performance obligations are, contract modifications, software as a service bundles, milestones, things like that. All have to be kind of thought about whenever you're trying to recognize revenue. And so step one, identify the contracts. What are my performance obligations? If someone says, here's your money up front, if I haven't done anything, I haven't met any performance obligations, none of that money is revenue. Your cash might be sitting, really well because you've been paid up front, but your balance sheet is going to show that liability and you're not going to be able to count that as revenue. So whenever you start completing those performance obligations, that's when you get to bill. And typically you try and bill in step. As costs arise, you bill for those plus your profit percentage. That's how I like to prevent clients from overbilling and basically at the end of the project not having any money left because they collected it all up front. That's what we're trying to prevent. It's super important so that they don't have cash flow crunches later at the end of the project when they just can't seem to get off site or they just can't seem to finish the project. And so billing in step with as your costs rise, if you sink a lot of costs into the project that month, well, then you should bill for quite a bit. Don't bill it based on just time that's passed or anything of that nature. It's dollar for dollar, in my opinion. Okay, then you need to determine what the actual transaction price is. That's going to be your cost, and then allocate those prices to performance obligations. So once again, we'll go back to building the house for an instance. If it's going to cost $100,000 for me to pour the foundation, and I get to that point in the contract, I can go ahead and say, okay, of the $500,000 total cost, $100,000 of its foundation. Whenever I bill for, send the owner the bill for that month, I need to recognize 20% of the cost. So I'm allowed to recognize that $200,000. Same for whenever I get the house framed up. If that's another $50,000, well, I can recognize $100,000 of cash on as revenue, essentially. The other remaining portions, if I've only got my concrete and framing up, I still have a $700,000 liability because I haven't earned that money yet. So that's grossly oversimplified, but that's the case. And so if this all sounds confusing and you're a business owner and you're like, oh my gosh, this dude is talking just gibberish right now, just hang in there, because there are some platforms out there that can definitely help you navigate this depending on what your business niche is. So other things that you're going to want to consider whenever it comes to revenue recognition for young, small startups and businesses is, were there any contract modifications, any change orders? Because now if the owner says, hey, I also want a mother-in-law suite on the back of the house, well, that's going to change your price. You have to give them a change order. It's going to change your contract price. Now they owe you more money and you've got additional costs. And so it moves all of those allocations around. And so it makes it difficult for people who aren't a project manager in the day-to-day to know, okay, well, now instead of it being $500,000 total cost, it's now $750,000, and the contract went from $1 million to $1.25 million. And so that can get you in trouble if you don't have all the ins and outs and information. So that can really blow up your financials if you don't keep your finger on the pulse. There's also variable considerations. Maybe you discounted their roofing because your roofer gave you a really good price. So you end up over recognizing revenue because your price for the roof was lower. And I'm still using that house metaphor because I feel like that's something that easily translates to most people. Most people are familiar with the process of building a house. So that can be very difficult to pinpoint if you've got variable considerations where pricing can change based on the customer or client. Another thing that can blow up your financials without you realizing it is non-refundable upfront fees. Sometimes, if that's a sunk cost, you can count that as revenue. In my experience, like if you say, hey, it's going to be $1,000 for me to draft you up a quote, and they send $1,000, I feel like most of the time that's relatively immaterial. Now, if your fees are hundreds of thousands of dollars and they're non-refundable, you may want to defer those and recognize them over time as the contract is completed. Once again, that's probably more gibberish, but if someone engages with me and says, I want you to onboard my accounting system into a new platform, and I say it's a $100,000 fee for me to do that, and they sign for a 12-month contract, you could, in theory, justify that is a met and performed performance obligation. Hey, I successfully onboarded them into the new system. I'm going to recognize that $100,000. But you need to make sure it's non-refundable and they can't come back and say, hey, after 6 months, I just realized that this platform isn't right for me. I'm going to need a refund. It can kind of get a little tricky right there. So sometimes they'll defer and recognize over time unless it's a separate performance obligation. And then the other thing is the cost to obtain that contract for like building that house, for instance. Incremental costs like a sales commission, like maybe you had a headhunter go out and find these clients who wanted this house built. Those costs get amortized over the life of the contract, typically instead of saying, oh, I've got an immediate $50,000 sunk cost because my headhunter found you. Once again, you're not allowed to recognize that revenue until the contract is substantially complete. It's all very, very confusing, and understandably so. And now that I've kind of laid it out and walked through it, I can totally understand why business owners, bank officers, investors might get a little confused, because this is my day-to-day. This is my day-to-day reality, is kind of trying to figure out How much money did we bring in this month? It's not the amount that came in the bank account. I have to do transactions and basically book things to try and find, what really did we earn? And so it gets complicated fast. The good news is there are platforms out there, at least for some of these more tech forward and tech centric businesses who might be doing like software as a service, who run into these same things as the construction example, that can help you recognize the revenue as it is incurred. So a good instance is Puzzle. Puzzle really, let me actually throw Puzzle on the screen real quick. Now that Puzzle's on the screen, we can continue to talk about them. So Puzzle is like it's an accounting platform, very AI centric, but that's not the point of today's conversation. In this space for software as a service, for instance, it integrates with Stripe. And so if you can map and set up Stripe correctly, one of the Puzzle solutions is helping to automate revenue recognition. It's not hands off. You're still going to need someone who understands these basics, who understands the contracts. But once the system is set up, you can kind of step back a little bit, but making sure that everything is mapped and charted correctly is one of those things that is super important. Sorry about that, guys. Didn't realize that Puzzle wasn't on the screen there. But once it's mapped, that's one of the big draws of using a platform like Puzzle. So you can see here, like in some of their offerings, one of the first things that they have is revenue automation. And so that's something that they really pride themselves on. And if we drill into that drop down here, you can see that they kind of walk you through how the platform works, routing the Stripe transactions to Puzzle subledger, feeding the data into Puzzle, and then how it gets automatically recognized using the two platforms. So very impressive. I don't know of any other platforms out there that can necessarily do it to this extent for like construction or any large project-based accounting. Typically, you're going to have Excel worksheets. This is one of those things where accounting just gets relatively niche, and that's why CPAs and directors of finance and controllers have a job, because it's not just something that you can just plug and play. There's a lot of judgment calls that go into stuff like this to make sure that the money that you've received is actually business revenue and not a liability. Some of the other things that you might find that could be performance obligations in relation to recognizing revenue are like subscription access. As soon as they're turned on, do you get to recognize revenue? So like Netflix, as soon as I send them my $30 a month, is that counted as Netflix's revenue, or are they counting that day by day because I can cancel it anytime? If I cancel anytime, I don't typically get a refund. So you have to say, is subscription access a performance obligation? Is it overtime, straight line? Or is it recognized right then? Implementation and onboarding is another one. Once they're onboarded, can we recognize a portion of the revenue? Well, it depends. How much cost do I have associated with it? What do I think my costs are going to be? And so that needle moves around quite a bit as well. Training is another performance obligation. If I say I'm going to spend 100 hours with your team training you up on the platform, that is another one that can basically help accelerate revenue recognition if you have the cost baked into the contract. Term license, and then usage-based fees, any metrics that you can run to say, hey, they are using it, we're providing that value that we told them we would be, let's go ahead and bill and recognize the revenue. And okay, so we've gone like really deep into the weeds here, but here's another thing that's just on the opposite end of the spectrum. And so I'm going to go back to my full screen here just because I want to be able to kind of drill you in. We're wrapping up the video, but this is really interesting as well. You don't always end up with money in your account that's not revenue. Sometimes you can say, hey, I may not have invoiced the client this month, but we need to recognize revenue because we have costs tied into their project. So that is basically accruing revenue. It's the exact opposite of what we've been talking about. You may not have any money in your bank account, but your business can still showcase on the P&L, on a GAAP basis, accrual basis, compliant P&L, you can showcase revenue coming in through the door even if you have nothing in your bank account, because your obligations have been satisfied and you just haven't received the funds from the customer yet. That is one of the key facets of accrual accounting, of GAAP compliant accounting. And so once again, a lot of bank officers, a lot of business owners, if they don't see money coming in, it doesn't count as revenue. And that's just wrong. If you've been out there working every day and you just, hey, I haven't invoiced a client in 4 months because I'm doing really well on this job over here and I didn't need to, you should still include that in your monthly profit and loss. And it's just, that's why this is my bread and butter as a CPA. I love walking through these complex topics, these complex videos to show like there's more to it than just plugging everything into QuickBooks and saying, I'm running a profitable business. I mean, you may not realize it, but you may be $800,000 in debt because someone just paid you up front. And you could be thinking, wow, I'm really doing well with my business and doing well in life. So we can go even deeper, but this is the crux of it. That is some of the high points of revenue recognition. Like I said, it's a super complex topic. I really enjoy getting to like do the one-on-one and kind of walk you guys through it. But as a CPA, like it can get a little hairy even for me. And I'm in it day in and day out. So I can only imagine how the lowly bookkeeper or someone who just skims the financial statements and then gives you a loan for, I can totally understand how they could misidentify key factors such as this. So anyway, guys, hope you learned something. Thanks for watching, and I hope you guys can find a platform that can automate some of this stuff that works for you and your business niche. Thanks for watching.